Hello there. The second part of Lecture Series 14 of Bite-Sized Corporate Reporting on IAS 8 focuses on accounting estimates and errors. It is inevitable some of the monetary amounts in the financial statements are subject to measurement uncertainty, given accounting policies may require items to be measured at monetary amounts that cannot be observed directly and therefore must be estimated instead. Examples of accounting estimates include 1. The net realizable value of an item of inventory applying IAS 2 inventories. 2. The fair value of an asset or liability applying IFRS 13 fair value measurement. 3. Depreciation expense of an item or PPE applying IAS 16 property, plant and equipment. 4. Provisions applying IAS 37, provisions, contingent liabilities, and contingent assets. An entity may need to change an accounting estimate if there is a change in the circumstances on which the accounting estimate is based on, or as a result of new information or developments. Change in accounting estimate does not relate to prior periods and is not a correction of an error, as by its nature, accounting estimates involves measurement uncertainty and requires the exercise of judgment or assumptions based on the latest available reliable information. IAS 8 requires a change in accounting estimate to be recognized prospectively in the profit or loss in the period of the change or the period of the change and future periods if the change affects both. Next, errors. These are misstatements or omissions in the financial statements relating to the recognition, measurement, presentation, or disclosure of the elements of financial statements. IAS 8 stipulates current period errors discovered in the period shall be corrected before the financial statements are authorized for issue. However, it is possible errors of the previous period may only be discovered in the subsequent periods. In these situations, IAS 8 stipulates material prior period errors shall be corrected retrospectively. An entity shall correct the material prior period error by restating the comparative amounts of the prior period or periods presented in which the error occurred. However, in the case where the error occurred before the earliest period presented, then the entity shall restate the opening balances of assets, liabilities, and equity of the earliest prior period presented. It is important for an entity to include the relevant disclosures set out in IAS 8 on changes in accounting policies, changes in accounting estimates, and prior period errors. This ensures the relevance and reliability of an entity's financial statements are enhanced, as well as the comparability of those financial statements over time and with financial statements of other entities. This concludes IAS 8, Accounting Policies, Changes in Accounting Estimates and Errors, focusing on 1. Objective of IAS 8, 2. Definition of accounting policies and accounting estimates, 3. Selection and changes of accounting policies, 4. Accounting treatment relating to changes in accounting policies, changes in accounting estimates and errors, and finally the importance of disclosure under IAS 8. The next bite-sized corporate reporting lecture series will look at IFRS 13 fair value measurement. Till then, thank you and have a nice day.